Jeff the Wealth Builder here on a Tuesday edition of Money Mondays with Jeff, where we talk to dope financial professionals and get the insights and the money tips to how to build this generational wealth so that each generation can get richer and richer. And today, I am so happy and grateful to be talking to the Philly legend, the tax strategist himself, Mr. Kamari Ellis. How are you doing today, sir?
Oh man, you're too kind. Thank you for having me. Thank you for having me, sir.
So, I've been waiting for this to have this conversation for quite a long time because I think, taxes are one of the most important things that is never really talked about enough, I believe, when you're in these financial planning circles, this financial education circles. I mean, everybody can tell you how to make the money, but not too many people can tell you about the strategies on how you can keep the money and leverage the tax code so that you can have more of the money that you're making. So I think this conversation is very important and very enlightening, and hopefully people can walk away with a nugget or two, because taxes are going to be the biggest expense for the rest of your life. And if you don't have a strategy on how to utilize the tax code, then shame on you. So that's why it's important that you have a tax strategist, a tax professional, someone who knows the ins and outs of the tax code in your corner to help you, because when you understand what's going on, you'll know what to do. And that's the whole purpose of why we do this financial education, to make sure that you are educated, because education is the key. And I know, they trying to strip away the education and trying to keep you dumb and dumber so they can make more money from you. But we're going to keep giving you the information so you can get wiser and that you can be in a position to financially win. Is that all right, y'all? We're going to say that's all right. That all right with you, Mr. Ellis?
Let the church say amen.
Let the church say amen. So let's break this down. My first question for you tonight is what's the difference between tax filing and tax planning? Because you hear people get a lot of anxiety each and every year. Every time April comes around and it's time for them to file their taxes, they are always on edge. Like, oh my God, I got to get my taxes done. So tax planning and tax filing, what's the difference to you in your own estimation?
So every year the government deems that everybody's supposed to file their taxes, right? So that's a compliance thing. You have to do it usually April 15th if you're an individual, March 15th if you're an LLC or a partnership, right? That's the filing component of it. The tax planning is everything you do before you can begin to file. That's all the strategy. That's all the research. That's all the bookkeeping. Because I want to say this real quick. You can't do any real tax strategy if you don't have great books, because books are the foundation of any good financial empire.
No, back that thing up. Back that thing up. Tell them a little bit about them books, what that books mean, because some people going to speed bump right over that. When you talk about books, break that down so like a 9th grader, 10th grader who's hearing this will understand why books are important in tax planning.
Right. So when we talk about books, we're talking about bookkeeping or accounting systems, whatever you want to call it. And that is the way you either track the money that's coming in and also track the money that's going out. And by doing that, that's what helps you be able to really leverage the tax code. You see a lot of people on social media, and they'll say, buy a G-Wagon or do this or they do that. But normally, a lot of times, they're just making stuff up. The real sexy part of taxes is super boring, because nobody likes to do books. That's why so many people are afraid of taxes. But it's the books. It's recording the debits and credits, if we go back to accounting 101, right? But that's just money coming in and money coming out. It's really that simple. And a lot of times people are really scared of that.
So what do you see the number one mistake high income earners making as it relates to taxes?
I see the same mistake from high income earners to low income earners. They don't keep good books. I can't tell you how many books, right, accounting records I saw during COVID. A lot of people got the PPP, right? People was having a funky old good time with the PPP. I saw a lot of people that were small business owners and, decent sized business owners recorded their those loans they got as revenue, as sales,
Oh,
instead of as a loan. And so they inflated the money that they got instead of actually recording it properly, because you don't pay tax on loans. It's a debt. You have to pay it off over time. And if you record it properly, it can be done pretty simply, but a lot of people don't do that, and they don't do that.
okay. So I know a lot of people came on here because they wanted to hear some strategies on, this tax game, and they don't want to hear the boring things about why books are important and why your debits and your credits and how you have to keep excellent records, and if you don't document it, it didn't happen. They don't want to hear about those things. They're like, give me the strategies, give me the strategies, give me the strategies. So let's talk strategies right here. So when you look at the tax code was written for, I like to say, the business owner and the landowner. That's where all of the incentives, that's where all of the quote unquote, write-offs all occur in business ownership and land ownership. So what do you see as, things that the 1% are doing, the rich and the wealthy are doing as far as tax strategies that the poor and the unfortunate can learn a thing or two from?
You're not going to like this answer.
Okay.
They do books.
They do books. We go back to books.
Warren Buffett has a great accounting system, right? Because it's not just, and we can talk about some strategy too, but I just want to nail this home.
Okay.
It's one thing to do the tax strategy, right? And you get the depreciation, G-Wagons, all that. What happens when the IRS comes knocking on your door and says, that thing is BS? We're going to disallow it. I'm going through an audit right now with a client that wrote off some stuff they weren't supposed to. They can't substantiate or prove what it was for. And if it was a tax, it was really business expense, right? Because the IRS likes two words, ordinary and necessary. So if it's ordinary to the overall industry that the business is in, and if it's necessary for the business that it's in, for it to apply to your business. I had a client again, they said, hey, you traveled. How was this ordinary and necessary for your business? I think my client had written off some timeshare stuff or something like that. I don't know. But how is that ordinary and necessary to your business? They can't prove it.
That's why
right.
I guess that's why that documentation is king, right?
Correct. So again, I know it's not sexy, but that's the thing that will save your caboose and not have you up the creek without a paddle. Now, to talk about some strategies, I know everybody loves to talk about the Augusta rule. The Augusta rule can be pretty cool, where you use your business and you use your business to, let's say, go to your home, and you're using your home for business meetings. And if you use it for business meetings, and let's say 14 days out of the year, you used it, your company then paid you, you don't have to pay any taxes on it because it's under the 14 days.
Okay.
So that can be pretty sexy. Here's the thing though, because I'm always thinking about both sides of football. Jeff, I know you like sports. You got offense and you got defense. You could have great offense, but if you don't have any defense, it doesn't matter if you're putting points on the board because you're going to lose them. So again, you got to be able to document these things. All right. You rent it out your room to your corporation or to your business. How did you determine the rent to charge your business? Well, technically you're supposed to have market rate rents. You got to show research that, all right, well, this event space charges this much. Their room is comparable to my room. The place that they're located in is very similar to the place that I'm in. So it's comparable. The rents are comparable. Let's say, I don't know, it's $200 a day on the light end. All right. So you did it for, I'm going to just say 10 days. They had to take out the 14. So that's $2,000. You can write it off. You can say it's market rate rent. You can defend it. So the IRS comes to knocking. You can say, I got proof. I got backup, sucker. Now get away from me.
You also better have an agenda for that meeting that you had as well.
Absolutely.
You got to have all kind of proof, documentation.
A real meeting, absolutely. But that's one thing a lot of people can use.
Augusta rule.
Yes.
So do you believe that every, or let me, I'm not gonna say every, but do you believe that most people should have some type of business? A W-2 worker should have some type of business part-time to kind of take advantage of some of the tax codes that are in the IRS, because it's a lot of incentives that you can do, properly, structured and properly documented, that you can take advantage of having some benefits of that tax code. Especially for workers who are working W-2, they often say, work 40 hours for somebody else's job, but then work 20 to 30 hours on your own job as well, and building your own business. Do you believe that that is going to be essential for especially first generation high income earners to kind of have another plan for wealth building?
It can help, but I'm gonna say this. In this day and time that we're living in, a lot of people are dealing with a lot of stress, and they can't handle it. So sometimes they can't handle more than the one thing on their plate. But in theory, yes, it makes sense for people to have 9 to 5 jobs who are looking for some kind of tax deduction to lower their income, to have a consultancy / side hustle or something. Whether you like to get on YouTube and talk like me, or if you like to go garage sale hunting, or I got one buddy who likes to flip sneakers. He buys sneakers, he sells them on eBay, and I forget the sneaker exchange, but he does that. That's technically a business. So those are things you can do. So I don't see anything wrong with it at all.
I always like what Miles Monroe, said, when, back when he was living, he used to always say, find a problem and start a business. And I think that is like one of the big things that I think is a lot of people that are out here who are working 9 to 5 jobs, who have a lot of creativity and they have a lot of problem solving abilities. So I just wanted to encourage them that if that's you, if I'm speaking to you and you got those creative abilities and you have problem solving skills that people need, start that business, because the beauty is in business ownership, because you get to have the leverage and the control, and you get so many different incentives that you can utilize, especially with taxes, and especially if you're working with someone with the caliber of Kamari Ellis here. He can help you to kind of keep more of that money that you're making with utilizing strategies.
Absolutely.
Could you dive into a little bit about, I know we was talking earlier, and I call it the big beautiful bill, and one of the biggest incentives that it have for business owners now is that it kind of allows you to have a different structure and writing off your business mills, and it made it a little bit better. And you mentioned earlier that it was what did you call it again?
I want to look it up. You talked about the 100%.
No, I'm talking about, what did you call the new bill?
Okay, so I'm a little bit different, y'all. I call it a thing. I call it the big ugly bill, because what it's going to do with defunding SNAP and other things, I think it's a travesty. I was brought up in church. I was brought up to believe that we're supposed to take care of the least of these. So I don't see how it's beneficial for us as a country to deprive those of SNAP benefits, some of the pre-K benefits that are coming around. But I know we want to talk about the rich, so I know you might not want to talk about that too much.
No, that's good for it. Yeah, I mean, I think that's one of the most important things of wealth building is having a giving component. It's about, taking care of people. I think that's important. I think, I'm a compassionate capitalist, if there is such a term. I believe there's enough food on the table for everyone to eat, and everyone to eat well. I don't believe that I can eat at the buffet and you should be at the dollar menu. I think everybody is enough food for everybody to be at the buffet. So let it be.
Because I call myself something similar. I call myself the CBC, the conscious black capitalist, right? Because again, capitalism has gotten such a bad terminology, but a lot of times most people don't really know what capitalism is, so they just kind of run with it.
That's true. So what are some of the things and the highlights from the big ugly bill? What did you call it again? I'm sorry.
The big ugly bill.
The big ugly bill. Is there anything that you like in the big ugly bill?
I think, I'll be honest, I've looked at some stuff. So they kind of went back right? So I've been doing taxes since like 87. I'm a second generation tax accountant. My dad
Okay.
was in the business since the 70s. Every day I would go to school and then go to his office and go to work. You
Mhm.
could write off car loan interest back in the 80s. They just brought that back. That's one of the things in the bill. But I know it's only for a certain car, and I believe it's only for American made, depending on the year and all that. I haven't dove too deep, but let me do this. I can type pretty quickly and I can figure it out. So you were talking about the big beautiful bill,
Uh-huh.
right? You were talking about the big beautiful bill, and you were asking about meals, the meals deduction, right?
Yep.
So with the beauty of the internet, I just typed in the big beautiful bill meals deductions. And so I'm seeing companies 100% write off. That's what you were talking about. Food and
Yep.
drink publicly 100%. Meals expense during entertainment 50%. Entertainment expenses are still zero because they got rid of that during the TCJJ.
Yep.
But it's
I was
still
hoping they bring that back. So when you get your 6 or season tickets, you can write a little bit at all because you're gonna take some of your clients there. But that
you're
didn't
a good
happen.
man, huh? Well, I know you're excited about the Eagles too, so we're coming off that loss as well. But yeah, you would think sports would have pushed a little bit harder for that because everything's kind of a function of lobbyists these days. And again, I'm not trying to get down on the politics, but everything with taxes comes down to politics. So I would have thought that would have come back because there's too many corporations that have box seats, season ticket holders, and there's a lot of money there. But they got rid of it. They did away with it. I guess somebody fought hard for it up in Congress.
That just tell you that the restaurant industry lobbyist is a little bit stronger than some of the other ones.
Yeah, but because the restaurants cover there, but there's more restaurants than there are, sports and entertainment for more sports and entertainment venues. Yep.
If you
So
could get one,
okay.
if you could get one tax rule everyone should live by, outside of making sure that your paperwork is in order, what would that rule be?
Never spend money just to get a tax deduction.
Talk about that a little bit more.
So you always hear people say, I can write it off on taxes, right? But let's say, keep it simple. You spend $100. If you spend $100 on something, you're only going to get maybe 20, 30, 40% on a federal level as a benefit. You're not going to get your whole dollar back or your whole $100 back. So I always advise my clients to say, before you spend anything that you're trying to get a tax deduction on, make sure that there's a multiplier effect, that when you put $1 into it, you can get something out of it. For example, if you can put marketing, if you're going to spend money on your marketing, right? Marketing is one of the greatest things I think known to man for businesses. So because you put $1 into marketing, sometimes you can get $2, $3, $4, $5 back. That pays for a lot of other things. But you're going to get something more than what you put out. And you get the tax deduction. But if you just go spend the car and the car is going to depreciate anyway, does that really make sense? A lot of times it doesn't. That's just to stroke somebody's ego.
I would differ with you on that one.
Okay. What are you going to say? You could drive that Rolls Royce up to the country club and do
I
some
mean,
business?
Yeah.
Okay.
Especially if it's over 6,000 pounds, absolutely.
Yeah, but is it really ordinary and necessary for your business?
It depends on what business you're in.
So you're going to buy a G-Wagon to take your babysitters around?
No.
Take your babysitter.
Not gonna do that, but I would make a big investment like attending a conference or going on joining a mastermind, to improve my
education.
skills.
That's education. That's
Yeah.
education. I mean, listen, I know I said marketing, right? But I think skills, because we always talk about wealth,
Right.
So you got marketing that funds business, but you
Right.
need skills to help people to solve those problems you talked about, to attract people to come to you, to do a good job. You need skills, and then hopefully you're taking those those dollars that you're making from solving those skills and you're buying assets, whether it's stock, whether it's real estate, maybe investing into some life insurance. I know you love your life insurance, Jeff. Your cash value life insurance.
That's right. It's not an investment though, but we're gonna get into that later.
Very technical, but listen, man, I think I told you this. My dad brought me a whole life policy when I was 3 years old.
He was smart, man.
He spent roughly $100 a year on it, $28 semi-annually, something like that. I mean, there's several $1,000s in it now, so it's there. It's not an investment, but there's cash that's there.
It's the greatest. It's the greatest place in the world to put money to compound. That's what I like to tell people. It's nothing
from it.
It's nothing like uninterrupted compound interest and compound growth. Nothing beats it. Nothing beats it whatsoever. We're talking to Kamari Ellis, who is from the world famous Philly tax team. He is a tax strategist and specialist. We have him here tonight. He's also going to be a featured speaker at the Basic Financial Education Bootcamp that's taking place this Saturday. We're going to leave some information for you to get your ticket. You can come and meet Kamari. He has a great presentation lined up for you. And then you can ask him in person some of these tax questions that you can get free from. He's going to tell you, make sure your documentation is in order. Absolutely. But also he's going to give you some strategies that can help you to elevate your financial IQ. Because when you understand what's going on with your money, you're going to know what to do. So, could you give us some signs of what you have seen in your almost 30 years of being a tax professional, like problems that you can automatically forecast that someone's going to have issues with their taxes?
Oh, man, I feel like that's a trick question.
Why you say that?
So, I mean, because I've already said it, right? And I don't want to be like a broken piano, right?
No, but I mean, sometimes a broken piano is what people need to hear because it's that important.
So I mean, Jeff, you're in the financial business, right? So they always talk about us being pocket watchers, right?
Yeah.
Well, we can't help it. And we know when things don't make sense. So if you hear people doing all these extravagant things but they can't afford to pay for lunch, when you're out with somebody, you know, right? But listen, most people that have tax problems usually have financial literacy problems or financial education problems. They don't have a budget. They spend a lot. They're very compulsive spenders. You see a great correlation between the two. And I get it, because somebody's going to come here and say, well, taxes are illegal and yada, 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 but it's the law. And so if you don't want to be like Wesley Snipes or Lauryn Hill or Fat Joe, you want to follow the law because you don't want to go to jail over taxes. So, you know, that's one thing when I see people who don't have a whole lot of financial literacy, financial education skills, when they don't have any books, I can kind of tell when they don't have any books. Those are some of the biggest things.
Not having your books, that's okay. So what's the difference between making money and being tax smart?
What's the difference between making money and being tax smart? That's interesting. So, like, you know, we were having a conversation earlier.
Come on, let's talk about it.
You were talking about how you can basically set it up where you don't pay any taxes.
Yep.
And so I agree to that to some degree.
Okay.
You're always going to pay some taxes. However, being tax smart, right? I like municipal bonds. Why? Because you can put money in there, the interest comes out, you don't pay any tax on it. You only pay tax on it when you sell it. And so you can start doing certain things. I love life insurance. I think life insurance, let me say it back, cash value life insurance is one of the greatest financial creations ever made. You can put the policy is designed right. You can put money in it. It grows tax-free. What did you say? Tax-free, guaranteed, uninterrupted compounding?
For life.
For life, right? So I think that's great. I also think buying stock is also smart with your money.
Absolutely.
Also, for many business owners, a lot of times they don't understand that you can structure your retirement plans to buy life insurance. And so then you're buying life insurance as a tax deduction. Now, normally when you buy life insurance, there is no tax deduction, but since it's wrapped around retirement plans, it then becomes tax deductible. Now that's more intermediate / advanced work, but those
Yes.
are things that you can do. Those are things you can do.
I especially love it when business owners, when we talk about business owners, like we wrap life insurance programs around key employees
Yeah.
that we can guarantee a pension for that key employee, that they can discriminate and choose the workers that they can kind of put these plans on, that they can have these retirement plans set up. And the beauty part about using life insurance is that the cash value could be used to pay the employee the pension, and the business owner can take a tax deduction for that. And when they structure it properly, they'll get all of the money back when the employee dies with the death benefit. So it's like one of these kind of things, like you can use life insurance for a multitude of things. The thing that gets me, like, is when we talk with people in our community, of people that look like us, we always got this false belief that life insurance is for when you die. You know what I mean? And so a lot of times we got to talk about, you're like, where in the word does life insurance, does it ever talk about death when we talking about life insurance? So, but it's one of the most important things I think that you should have in your financial portfolio. And when you have it, it just makes so many other financial vehicles work better. And the most important thing, it gives you options. And a lot of times, you know, I'm a big proponent of liquidity, leverage, legacy, and control. And it's some tax programs that are set specifically, that I know I get into a lot of debates with tax professionals, is with tax deferred plans. And one of my biggest hangups on tax deferred plans is that you get penalized if you want to use your money if an opportunity comes up. And then people always say, well, that's true, but where else could you get, if an employee is making a 3 to 6% contribution into your plan, you know, why give up the free money? And I'm like, first of all, that money ain't free. And second of all, you know, why not put it into a Roth 401k when you don't have to worry about the taxation of the money later on, when you're going to be taxed to an unknown income tax rate and you lose the power to have liquidity on your money. I think liquidity is one of the greatest financial tools that you should always have access to. Liquidity, because if an opportunity comes by and you can't move because your money is tied up, that is one of the worst feelings you can ever have.
I mean, there are a lot of Roth 401ks now coming into play. They weren't so much, let's say, 5 years ago, but now
Yep.
a lot of these big companies have Roth 401ks. It's funny. I got a client of mine who asked me to kind of design his plan. Now, I used to be a financial planner, financial advisor, whatever you want to call me. I let go of all my licenses, but my clients will still call me for certain things. And so I said to him, I said, listen, you've got a Roth 401k. Put your money in there. So he had the person from the company, the investment company, call and say, well, he probably shouldn't do that. He probably should do the pre-tax dollars first. I said, yeah, I can see why you say that, but it's my belief it's better for him to put the money into the Roth. We're just avoiding RMDs. For most of y'all, we're nerding out a little bit, but required minimum distributions. That's when the IRS says your money's been in these retirement accounts. We can't get our grubby hands on them and tax them. So you got to take the money out at 72 and a half. It used to be 70 and a half, but now it's 72 and a half. But now you can just put the money into a Roth and you don't have to worry about that at all. A lot of people don't think that's important, especially if you're younger than, let's say, 40 or 50, because you don't see the impact of it, but it gives you more control. Because back in the day when they were talking about retirement, it was just a pension. And they were like, all right, most of the time your house is going to be paid off. Everything's going to be paid off. And now everybody's getting these new 10-year car loans, these 50-year mortgages. You know, people are dying with their mortgages still 50% left out or outstanding. So you've got more and more stuff. So you're going to need to make more and more money. And sadly, you got to make more and more money you're going to pay more and more taxes. So
It's
why not have
interesting.
a bucket of money that you don't got to pay taxes on?
It's interesting. I have some clients who've done everything that I told them, and they are financially well, and they're well off. And we are having a debate right now, and maybe you can help me out a little bit, right? Because I'm gonna tell you from the lens that I see it from, and maybe you can give me some guidance or some correction, or give me a different perspective to look at it. And we're gonna answer Jerome Wiley's question: what about a self-directed Roth 401k or self-directed 401k? You have more investment options. We're gonna get into that in 1 minute, but my question is this. I have several clients who have over $1 million plus portfolios, and they are at the place right now where they are at the RMDs. So they have to take the minimum distributions out of their money. And I'm calling them. I'm like, you're taking your RMDs out. I'm like, so how does that make you feel? And they're like, I don't need the money. I got to pay taxes on the money. I wish I would have never had done this. I wish I'd have did something different, because now I got to pay taxes on this money. And I'm like, and I sit there and I'm like, So I said, well, have you ever thought about spending the money and just paying taxes on the money while you know what the tax rate is on the money? Because the longer that you keep stripping these required minimum distributions out, you're paying the taxes on it right now. But if taxes, I think taxes are going to go up after whatever next administration comes in, just because when I go to usdebtclock.org and see that the deficit right now is approaching $40 trillion, and the government's only source of income is through taxation or printing money, like something's got to give. You know what I mean? So I'm like, pay the taxes on the money while you know what the tax rates are. And then secretly, I believe like Uncle Sam and Aunt Bunny is secretly like clapping, like, yes, he took the RMD out again. He didn't take the money out. Yes. Because, the average American, depending on what statistics you look at, is living to about 87 years old. So
Right.
if people keep stripping out the required minimum distribution every year, and they've acquired this large nest egg that's in tax deferred accounts, 401ks, IRAs, 457, 403b plans, then what happens at 87 when you lay down and take your last and your final breath? Then the IRS, Uncle Sam and Aunt Bunny, becomes your primary beneficiary of your life's work.
No, they don't.
Why don't they?
So my dad just died. And listen, my dad did a lot of things right. A
Right?
lot of things right.
Right?
A couple of things he did wrong.
Okay.
My dad's divorced. He didn't list me as a beneficiary on his IRA. However,
So
I
that
get
would.
it. I get it. It's not a lot of money, but I get it. So the IRA,
Oh, you said it was not a lot of money,
no, it's not a lot of money.
but these people got millions of dollars in their account.
My point is, per law, their next of kin will still get it. That's all I'm saying.
No, what I'm saying is that the IRS, Uncle Sam and Aunt Bunny, which is the state, collectively, they're going to get a big chunk out of that money. And if you got more than one beneficiary, let's say your dad named your mother and you as a beneficiary, Uncle Sam and Aunt Bunny gets more money than you and your mom.
It depends. It depends.
Well,
Not always.
how?
They,
How does
they
it?
did, they did change one rule though, right?
Okay.
They make you spend. They make you spend the money over 10 years. I believe the new rule is 10 years now.
No, but when you in a 401k and the IRA, you got to pay taxes on that money immediately.
Yes, but it's no higher than your overall tax rate. Now, what can happen?
Now, if you got $1 million in that account, that money ain't never been taxed. So you're paying the top tax bracket 37% on that.
That's only if you pull it all out right away. Why would you pull it all out right away? You pull out over time. Here's a question for you, and this might be a little off topic. If you win the $1 billion Powerball, would you take the payout?
I had this conversation with my wife, and I looked at it from the standpoint, that the cash payout and the annuity payout, I think the time when I did the estimation, if I lived like 6.7 years, I would be getting more money on the annuity payout than the lump sum.
And
So
so you stole my thunder a little bit because you're a smart guy. But the other thing is the money grows, it gets a COLA, right? Or cost of living increase.
Yep.
We speak in jargon for everybody that's watching, right?
Uh-huh.
You get that, and you get to separate. You don't get to pay tax on it right away, because if you take the lump sum, you get
you gotta pay taxes.
now. If you take it out a little bit at a time, you got a little bit more tax flexibility. I mean, but what is it, 20 years or whatever? So you're still getting a big sum of money. The highest tax rate, I want to say, on the top of my head, is 34% federal, and so it's still going to be a lot. It's still going to hurt. It's going to $1 million. It's still going to hurt. I'm just saying, you can do some things.
Even if you took it out over the 10-year time period, that's still $100,000 plus a year.
Yeah, and it's still going to hurt. It's still, but some years you can take 50. Right? Some years you can do, you can do some things. But I was going to say something.
Right.
For some of your people who got money, you said spend it. They could also roll that money into a Roth. You still got to pay tax on it, but if they don't need it, it now becomes unencumbered, right? It's not growing tax free. So that could be another option for them as well.
Yes, and that's one of the things that I stress to them too. Don't let the money just sit in the 401k.
Right.
The longer you
401ks, man. Why you don't love 401ks?
I don't like the taxes on them. I don't like the fact that I don't know what the taxes are going to be in the future. And I know right now that taxes are low. Okay. And I know that the tax brackets right now are favorable for income being, if you have retirement income, to take the money and pay the taxes on it now. And I just don't know. The thing that frightens me right now is that the spending right now that our government is doing, that the debt that our government is in, and that our only source of income is taxation. I want to pay taxes on the money now, and then I want to put it some places where it will never be taxed again. That's why I love the Roth 401k. I'm like, I love the Roth IRA. I'm like, pay the taxes on it now, and then don't worry about it no more. It's done.
So you don't believe your president when he says tariffs are going to do away with income taxes?
I'm gonna tell you something my mama used to always say to me. God rest her soul. She's in heaven right now with Jesus, right? My mama used to always say, "You ain't gotta feed me a whole cow to tell me that I'm chewing beef." So I'll leave that right there. If you think that tariffs are going to be something that's going to get rid of the deficit, meanwhile, the deficit has grown almost $2 trillion since it's been in office in 1 year.
No, not deficit, income tax. He said tariffs are so successful that it's going to get rid of income tax.
Okay, so that's waggle beef that she told.
You ain't have to breathe in deep like that, man. That's what he said. I didn't say it.
Yeah, right. Yes. Okay, you're right. I mean, I was just looking at the deficit, right? And when you look at the deficit in 2016, I mean, we talked about this a little bit earlier, right? Was at $19 trillion, bruh. And now we're approaching $40 trillion in less than 10 years, bro. It ain't been 20. It's 10 years. Our deficit has grown and doubled more in less than 10 years. Like, this has got to stop, like, somehow. And then the real numbers have not been even calculated on what this new tax bill is going to add to the deficit.
Yeah.
So you want me to put money in accounts and defer money to an unknown tax bracket? I mean, an unknown tax rate, and taxes are like doubling, and and Congress is at happy hour right now. They buying the bar in every city and every state in America, right? I mean, not even in America. I mean, we bailing out other countries and giving them $40 billion, and we spending all of this money. And you think that I want to put money in accounts that's going to defer, that my money will potentially have to pay for that? Nah. I'd rather pay for it. I'd rather pay the taxes now and get it out the way.
I mean, but the trend is taxes have been going lower over the last 70 plus years. So it could go lower. I mean, but I understand the side of that you're on. You're like, I don't think it can go much lower. It might.
They say history don't repeat itself, but it rhymes, right?
Yeah, but the trend though,
Okay.
taxes have been going down. But
Okay,
I get it.
You remember this guy? You remember this guy who they still, the Republicans are still playing this trickle down economics game with, right? You remember this president we had named was Ronald Reagan. You remember that guy?
Mm-hmm.
So do you remember why Ronald Reagan got into politics? Because he was working as an actor. He was an actor, and he wouldn't make more than one movie because the tax bracket with the federal and the state taxes was over 100% of his money acting. So he didn't make that more movies because he didn't want to pay all of his income to be consumed to taxation. But back in them days when Reagan first got into the business, almost everything was a write-off. You could write almost everything off. Now, if you're a W-2 worker like he was, you're basically down to your home, you're basically down to your kids, and you're basically down to medical emergencies are your three biggest write-offs that you can do now.
And your charitable deductions.
And your charitable deductions. Yep. And right now, you're gonna tell me that taxes can't go back up? Yeah, it's been a trend.
I'm not going to say they can, but
it's been a trend. Down. It's been a trend on the last 10 years, yes. But what goes down has to come back up, right?
Maybe. Or what's going down keeps going down. So I don't know. But to your point, because I agree with you, why not? Why play with it? Why not lock it in? But I do believe you got to have a really comprehensive financial plan and doing it. And sometimes it makes sense to put money, let's say in an IRA where it's free tax. A lot of times it makes sense to put money into a Roth IRA.
We're going to agree to disagree because my thing is,
I'm just saying you need a full plan. I'm kind of agreeing with you. I'm
not doing anything tax deferred at all. If I'm going to do a 401k, it's going to be a Roth. If I'm going to do an IRA, it's going to be a Roth because I don't want to deal with the tax demon later on in life because I don't know what it's going to be. So I err on the side of I'm gonna pay what I know. Then it's like this, like the old saying go. The old folks always say it's better to deal with the devil that you know than the devil that you don't know. Right?
That's right.
I'd rather deal with the devil that I know.
Absolutely. What up, Karan?
Yeah, Happy New Year, Karan. So let's check this out. What are three? Let's get back to the write-offs, because we want to keep it spicy a little bit. But what are three of the write-offs that people think they can take, but they shouldn't?
Oh man, where should I start?
We talked about the G-Wagon already.
People love to write off their clothing. A lot of times people like to write off their clothing. Write off their clothing. What do you mean? So suits. I mean. I did a video not too long ago on Myron Golden.
Okay.
Everybody loves Myron Golden. So he talked about his suits and how he could write off his suits. And because he put a little logo on his suit on the inside of his jacket. Nice suit.
Okay.
Nice suit. But, a lot of people want to write off their clothing. The question is, again, is it ordinary and necessary? Is it something that you can wear personally, or is it truly something for work? I've seen people that worked at Polo. There was a case. It was a tax case of this guy who worked at Polo, and he brought all his Polo clothes, and he tried to write it off, and the judge said no. Why? Because you're wearing it. It's a personal benefit. It's not for work. Doesn't matter that you work at Polo, but that's something you would wear. It's not out of the way that you wear Polo to your job that happens to be owned by Polo.
So here's a follow-up question to that, right? So let's say for the conference that's on this Saturday, right? So if I wore a 3/4 sweater like I'm wearing right now, and I'm going to be speaking at the conference, and it had my logo on it, and I wore this in the event of the speaking at the summit, and I got the pictures and the video and all of that stuff to prove it, and I got the agenda and the program book from what happened on that event. You should not be able to write off the clothing for that function.
I would say yes, and guess what I'm going to have on? And by the way, the young people call it a quarter zip now. They're saying
Quarter zip. I'm sorry.
That's all the new rage now. Us old heads, we never wore them, but I wear those. I've got my logo boldly embossed on it, and that's my uniform. That's what I wear every time I usually go out. Just about every time I go out. So yeah, you can write that off. You definitely write it off.
Now, so you're saying that if the same thing applied and you had a custom suit on that you paid for, and maybe you had your name inside of the jacket, that would be questionable?
Yes.
Okay. I just wanted to set the.
Yeah.
I just wanted to set the.
I got you.
Okay.
So that's one thing. What are some things? Oh, haircuts. I used to work with a lot of firefighters in Philadelphia, and back in the day, they had to always keep their facial hair cut or trimmed or whatever. A lot of times they would try to write it off. I wouldn't do it because that blurs the line. That's personal. However, you got some tax preparers. I won't call them tax professionals, but you got some tax preparers who did write it off for them, and it helped them get more money in their tax refunds.
Okay.
So that's one.
Is that because it was mandated by the city?
No, but it's still personal, right? It's still your own personal grooming habits. It's not quote unquote for the job per se.
Okay. So we're talking to Kamari Ellis, tax professional from Philly Tax Team in Philadelphia, a legend right here. They're almost 30 years in the game of taxes and helping people with tax strategies and really like giving people the financial knowledge to help them to be better tax people when it comes to keeping more money that they're making. He's going to be a featured speaker at the Basic Financial Education Boot Camp that's taking place this Saturday at Cherry Hill, New Jersey at Maggiano's. You're going to get a 3-course meal. You're going to get a copy of my autographed book. I wrote a new book, The Basic No BS Guide to Building Indestructible Wealth, to kind of give you a blueprint on how to plan and do this money thing, because money is confusing. It doesn't come with instructions. So this is kind of like a guide to kind of help you to understand what's going on with your money, so you know what to do with it. And Kamari is going to be there on Saturday to kind of give you some tax knowledge and bless you in the area so that you can try to eliminate just some of the confusion as it goes to tax planning and tax strategy. So we're excited to have him on the platform this Saturday. Maggiano's 10 to 4. If you want to get a ticket, you can go to basicwealthtour.com and get it there. Another question that I have for you is that we're talking about write-offs, and people are always curious about write-offs. What can I write off? What can I write off? So we're trying to make sure that some of that information is there for them. But what are 3 write-offs that people are missing that are totally legal and common?
I work with a lot of real estate investors, so I'll stick to that.
Okay.
A lot of times they miss out on what's called depreciation. So anytime you buy a building, let's say, you buy a rental property, let's say you pay $100,000 for it. You can't write the whole $100,000 off in that year. However, the IRS wants you to write it off over, let's say, 27 and a half years. I see people miss that out a lot of times. I see many of my real estate investors not write off their cell phone bill. Now, you got to be careful with the cell phone bill, just like we talked about earlier. Every time I advise on taking a tax deduction, I'm always thinking about if it's going to be challenged by the IRS. So if you just have a cell phone bill, right, and you're going to say, yeah, I do 100% business on this phone, the auditor is going to ask, you don't call your boo? You got a baby mama? You got a mama? Right? Do you call any of those people? If you say yes to that, they're going to say, well, you can't say you use it 100% for business. So I'm always really quick to say, hey, you can't write off the cell phone bill 100%, but you should still write something off, right? I would say, start at 50% because you're at least using that business 50% of the time in commissioning your business. So that's legitimate. I see a lot of people miss out on mileage. A lot of my real estate investors and regular small business owners, they miss out on writing off mileage because a lot of people don't track their miles when they're going to and fro and to their business and all that. But I tell people, again, use a smartphone, get some of the mileage apps. I don't want to give anybody a commercial, but there's plenty of apps out there that will track your miles when you're driving to and fro doing your business. That's a legitimate write-off. I want to say this year the write-off is 67 cents a mile. Now, some people think, oh, just 67 cents. But when they say pennies add up or pennies make dollars, I've seen a lot of people miss out on it. And let's say they did a tax return and I say, all right, did you write off mileage? No, I didn't write off any mileage. I'll come back, I'll recreate their mileage log. I'll say, you just saved the $5,000 just because we calculated you going back and forth from stuff you were doing anyway. Right.
Oh, wow.
So those dollars add up really quickly.
Wow. What's the easiest thing somebody can do to lower their taxes without doing anything shady?
Well, it's all up. So you got to think about it, right? You said it earlier, and I loved how you said it. The tax code is built for business owners and farmers, right? Or landowners.
Mhm.
So if you start to think like a business owner or landowner from the gate, you will know that one, paying or making money from a 9 to 5 job isn't the best way to make money from taxes. I ain't telling nobody to quit their jobs, all right? I don't want that smoke. But what I am saying is that when you start to build up assets, let's say in stock, and you're getting dividends, that's going to be taxed lower than the money that you get from your 9 to 5 job. Let's say you buy a property and you sell it and it was profitable, right? Because sometimes it can be a loss, but it's profitable because you did all your books, you figured out you made good money. That's going to be taxed lower than the money you make on your 9 to 5 job, right? Especially if you own the property for more than a year. So, those are some things, just how you set up and you structure your life. You might not be able to do it for every little thing, but you can say, you know what? I'm going to start taking some of my money and I want to put it into assets that will generate me income to offset what I'm making at my 9 to 5 job. And so, like, as you said, being a side hustler, right? Or having a 9 to 5 job and also have a business on the side that could help you out right away. This is how you set it up. I work with a community of people who are quote unquote called overemployed. They work 2 or more jobs, 9 to 5 jobs. They make a good piece of money too, a lot of times. But then they figure out how to take their business or their jobs and become consultants. And so they get to write some of the stuff off. They get to write off their conferences. They get to write off when they're taking clients out to places, right? That's really business, right? So, there's a lot of things that you can do to really, I won't say all, right? I don't want to do that because you got some people out here that says, write off your whole life. Well, you can't write off your whole life. At least not legally. You can't do it, but you can write off a lot of it. You can write off a lot of it if you're smart.
I like to say taxes, is not what you make, is what you allow to keep and enjoy. And one of the things I like to say to my clients is make sure you find a good tax professional, a good tax strategist, because I want them to have quarterly meetings, and then, have them to ask their tax professional questions to kind of help them to kind of like learn where the incentives are in the code, because I think that's important as it relates to your business, right? So what does it mean in your opinion to do tax planning instead of, filing and praying in April?
So I want to say this because my tax pros get a lot of flack for filing taxes, right? Because you got all these people running ads that say, if you just want to work with somebody who's not just filing your taxes, you got to have clients who are willing to do the work. A lot of times clients don't want to do the work and they don't want to pay to do the work. So I wanted to be clear about that. There's a lot of good tax professionals out there who file. They got a big practices that file, are willing to do the work, but a lot of times their clients don't want to pay the fee. But the fee, when you pay it, pays dividends over time. But I would say, yes, you should be talking to your person at least quarterly, especially if you got a business or real estate investor. Y'all should be figuring out because, again, filing taxes happens once a year. Your planning is all year long, or at least it should be. I tell people all the time, if you wait till tax season and start tax planning, you've already lost. If you wait till after December 31st of last year, you kind of already lost. There's only a couple of things you can do between now and the tax deadline. But for the most part, you want to do everything before the end of the year. So I say, if you missed it last year, start doing it now. Think about what you want to do. If you want to do a business, because everybody doesn't want to be a business owner, and I get it. But let's say you do. Start now. Start planning for it. And you can do a lot of things. You can do a lot of things, whether it's conventions that sharpen your skills, a mentor, a coach, a class. A lot of those things can become tax deductible, and use your job as your first investor to pay for this stuff that you're going to do. So, you can be really smart about your money.
That's right, because an investment in you always pays the best dividend and the highest one.
Absolutely.
Can you share like a quick story of like how you helped a client with a small change in their taxes that helped them save a lot of money?
I mean, yeah. This will be funny. I had a client who owed the IRS $70,000. They had been getting garnished, I don't know, I think for at least 3 or 4 years. All I did was file their taxes. I know it might seem weird. They
Come
want to
on.
give their money back. Listen, again, like, I know everybody wants to make taxes seem like a super duper complicated. And listen, some of it is. Like when you get into some of the advanced depreciation, double depreciation rules, it can be. But if you just file your taxes, that'll get you 90%, 95% out of the way. Now, there are some things you need to do during the year. Let's say you got 2 jobs. So sometimes they might not be withdrawing money enough, and then you might wind up owing money because you made double the money, right? So you went up in a couple of tax brackets. But if you just file your taxes 9 times out of 10, you'll stay out of trouble. But that's an example of some things or one thing I've done to help some people that was fairly simple. Just file your taxes.
That's crazy.
That's it.
Can you share one move that people can make maybe like in the next 30 days that they can get more in control as it relates to their taxes or, their tax strategy or their tax planning?
It's going to go back to books.
Okay.
That B word that everybody hates. And I'm not talking about a female dog, y'all. I'm talking about budgets.
Okay.
Track your money. See where your money goes. A lot of times people have no idea where your money goes. And I don't want to be the latte Nazi or anything like that, but just see where your money's going. Because let's say you do have a tax bill, because I help a lot of people get out of tax debt. If you can control your money, you can say, all right, well, instead of paying the IRS because their interest rates are pretty high, they're pretty hefty. Instead of buying that latte, pay it on your tax bill. But again, you got to see what you're working with. You got to see what all is going on. And again, if you track your money and you see what's going on, you can say, all right, well, maybe I'm not saving enough for retirement, because sadly, at some point, the body's going to give out and say, I don't feel like going to work no more. You might say in your mind you want to work no more, but your body says, I ain't doing it. I changed my mind. Lay your butt in bed. But guess what? The bills don't stop. So you still got to be prepared. You still got to put food on the table. Still got to pay the light bill. So, budget. I think that's one of the easiest things. And you ain't got to get super complicated. Just look and see what you spent and just go from there. And now the beginning of the year, grab all your bank statements. And I know this might sound super boring. Go boom. You got all this technology now to go through it in like 10 minutes and figure out what you spent last year. And so then you can just figure out, you can start making a plan, but you'll be more in control of what's going on.
That's right, because you can't improve what you try to avoid, right?
Absolutely.
So let's do a little rapid fire right now. Like,
you see Jerome Wallach said a question, right? You want to talk about that or not?
Go ahead. Yeah, he says, what about a self-directed Roth 401k or self-directed 401k? You have more investing options. He was talking about, I'm assuming,
versus a company sponsored plan.
Yes.
So listen, I don't have a problem with a self-directed Roth, 401k, whatever it is. You got to be careful with the tax rules, though. I know a lot of my real estate investors love the self-directed options. I know some of them who use them really, really well, but then I know some of them who try to get the money themselves. Because when you get the self-directed, or when you put the money in self-directed stuff, the individual's not really allowed to do any work,
Yep.
right? You can't be your own GC. You got
Yep.
to pay somebody to do it. You got to be
And
really,
what
really
a lot of people make the mistake too, without the, when you have them self-directed plans, you got to have a third-party administrator to kind of set that stuff up. And a lot of people think that they can do it on their own, and that's a big red flag.
Yep.
Big way to get audited.
And so again, I like it. I like it. I'm lazy, right? Let's say I'm financially lazy, right? I want it to be simple, easy, and fun. So I want to be able to set it and forget it. Now, that don't mean I won't do no research or anything like that, but I don't believe that all these complicated things you see people talking about doing backflips on social media create any more wealth than the average guy who just makes his money, saves it every week, invests it every week, and just minds his business. I don't think there's any more advantage of doing all the doing all the complicated stuff.
Let's do a little rapid fire.
All right.
One word. What's the biggest tax trap?
The biggest tax trap. I call it the exemption game. So
The exemption game.
Yeah, you have some people who will play the game and they'll increase their exemptions, not. So they're saying, all right, I got more kids this week because I want to have a higher paycheck and I don't want them to take as much money out of my check. I see people do it all the time. But then what I also see is when it comes time to pay taxes, they forgot to change it back to the regular rate. And then when at the end of the year, when it's time to file your taxes, the government says we want to put everything and get everything accounted for. They forgot and they wound up owing a bunch of money.
W-2 workers. What's one thing they should stop doing immediately?
W-2 workers?
Mm-hmm.
I would say stop underappreciating your job.
Ooh, that's a good one.
Or stop being unthankful for your job. I see a lot of people say, I got to go to the plantation again. I'm like, first of all, I'm a big history buff. I don't think you have any idea what plantation life was really like because you got it really good. But I'll say this, a lot of times people work 9 to 5 jobs and they don't uncover all the gems. Just read your employee handbook. A lot of times, I'll say this, my son was working for a major hospital in the Philadelphia area. I told him to read his employee handbook. He didn't. I got it and read it. They were giving major credits for houses in their area. This is a major hospital. And he could have took advantage. He's like, but I got to stay there like 5-10 years. I'm like, so what? You'll probably never be able to afford a property in that area. However, with their assistance, and I would help you, you will be able to own a piece of property in that area, and that would be great. Mm-hmm. But I would say unlock everything you can when you're at a job. And a lot of times there's more value there than you even discover, because a lot of times we're just being surface.
Yep. A lot of jobs pay for you to go back to school. Yes. You know, they give you certain incentives for staying on the job for a period of time. So same question, different way. What's the best habit, rapid fire? Best habit for business owners?
Master marketing.
Lack of marketing.
No, master marketing.
Oh, master marketing. Okay.
Yes.
What about the worst habit for business owners?
Not tracking their expenses.
Receipts, do you keep them or not?
Yes.
How do you keep them?
On
your phone?
So here, I think you'll find it. We were talking about mills earlier, right?
Right.
So the IRS loves to audit people's mills. I was just telling you about, matter of fact, the audit I'm dealing with right now. The one way you can audit proof your mills is when you get the check, take a picture of it, upload it to your accounting software. If not, put it into your email. I have people create a whole Gmail account. Let's say Jeff Taxes at gmail.com. Take a picture of it, email it to yourself at jefftaxes.com. But before you do that, right on there, what is the purpose of the mill, the date of the mill, what was the expected outcome of the mill. So me and Jeff met. I took Jeff to Butcher and Singer. I spent like
That's what I'm
$1,000.
talking about. You take me to a big dog place. I like that.
I said I took this on there. Jeff's going to give me $100,000 worth of referrals this year. Right, I'm putting this in the universe, y'all. I believe in manifestation.
Yes.
Right, but I'm going to take my fan out. I'm going to take a picture of it with all those writing and documentations. I'm going to send it to myself. I'm going to have it documented. So if I ever get audited, I can pull it out, and then I can say, "Hey, the supposed to give me $100,000 worth of business." And guess what he did, Mr. Iris Man? And I pay taxes on that too. Now leave me alone.
We talking to Kamari Ellis, tax strategist professional, Philly tax team, one of Philly's finest, been in the game for 30 years. He's going to be a guest speaker at the Basic Financial Education Boot Camp that's happening this Saturday in Cherry Hill at Maggiano's. We got a special offer for anyone who would like to attend, and this offer expires in the next 24 hours. If you go to www.basicwealthtour.com and you use the code HNY2026, you will get 50% off of your ticket because Kamari said so. He said, yo, hook them up with a little coupon. Let them know I'm going to be there. I'm going to come there, blaze the stage, and I want to answer all of the tax questions that people have live. So hook them up with an incentive. So I was like, all right, bet. So there you go. You go to www.basicwealthtour.com. Use code HYN2026. You get 50% off, but the key is you have to do it by 12 o'clock midnight tonight. You have to go 12 o'clock midnight tonight. So take advantage of that 50% off special. So make sure you do it now. www.basicwealthtour.com. Use code HNY2026. A couple more questions for you, Mr. Ellis.
Sure, let's have it.
So if someone wants to build wealth, someone wants to be a wealth builder, someone's interested in generational wealth and being, we always like to say, my name is going to be for generations long. Why is tax strategy important?
Because taxes are the biggest enemy to wealth. Right. Every transaction, right? Now I know you said one of the greatest. I think taxes are the most important thing when it comes to wealth. I'm biased. I'll give you that. But when you look at things, right, the federal tax rate, the highest one is about 34%. I'm in the state of Pennsylvania. Our tax rate is 3.07%. All right. So 34 plus 3, that's 37%. That's 37% of your money already gone. Plus, I do a lot of work in the city of Philadelphia. That's another 3.5%, 4%. So we're at like 40, 41%. And then we got all these other little cell phone tic-tac bills. You're giving the majority of your money to Uncle Sam, or a large part of it to Uncle Sam. So it behooves you to be really proactive about how to keep Uncle Sam out of your pocketbook or wallet and keep that money yourself and taking it and either, let's say, buying a life insurance for your kids, or investing some money in a brokerage account for your kids, or investing into your kids' Roth IRA. You can do that once they got a job, right? So, but you can take all that money, instead of sending it to some foreign country doing God knows what, doing God knows who, that you have no idea about, you can direct it yourself. Now, listen, I don't have a problem with taxes, ideally, right? Because we need roads, we need firefighters, we need to take care of our elderly. We need to take care of our children. However,
we got to take care of Argentina too.
We don't need to take care of Argentina, nor Venezuela, nor Israel. I don't want to get in trouble, right? I might not want to repeat that, right? But, that's the decisions a lot of our lawmakers are making with your tax dollars. And it's not always fair. So I'd say follow the rules. They're all public. You just got to do some things. Got to have a little bit of discipline, but it ain't that hard. It ain't that hard.
So what's the message that you would give someone who always says, you know what, I'll handle that later?
What's that saying? My mother beat it in my head. Never put off what you can do today till tomorrow. Right? Because It seems like, I don't know, man, and I'm not trying to be morbid, but as we get older, we start realizing just how precious life is. And so I don't want to give the IRS not an extra penny. So I want to start being proactive now. I want to do it now. What's that saying? Power is in the now. The greatest power is in the now. So I would say do it now. And again, it's not super complicated. Just start paying attention where you spend your money, what you're paying taxes on, what are you getting from it, what value do you get from it. That's what I always say.
That's awesome. So you're going to be speaking on Saturday, right?
Yes,
So
sir.
who needs to be in the room to hear, the tax magic that you're going to put on the people?
I'm going to say everybody, but especially business owners and real estate owners. And for the record, when I talk about real estate owners, I consider them business owners too. It's just a little bit different for them because they just think their business is just rent. Well, if you treat it like a business, it can pay you like a business. You got to just treat it like a business. But I would say anybody who is serious about generating wealth and who does not want to be a pawn to the system, they should be in the building.
That's what's up. You can get your ticket again at www.basicwealthtour.com. Use code HNY2026. Get 50% off your ticket tonight. One final word. Where could people find you?
You can find me all over the place, but you can find me at phillytaxteam.com. phillytaxteam.com.
phillytaxteam.com. Is that across all social media as well?
Across all social media. But, mainly you can go onto the website. If you want to book a call with me, going over there.
They get any kind of special code for mentioning Jeff the Wealth Builder?
We got to work that out. But, yeah, we could do that. We could do that.
All right. That's game. I like that. So, thank you for, being on this live tonight. I hope people got some value out of, hearing a tax perspective on why it is so important to have strategy, to have a professional in your corner to kind of help you to navigate all of the incentives that are in the code. Again, the tax code is written for the landowner and the business owner. So you want to make sure that you have a superstar in your corner to help you to navigate this game that we talk about taxes. Is there any question that I should have asked you that I didn't as it relate to taxes?
I think you should have asked about the mindset.
The mindset. So talk about it. What about the mindset that I should, you want to share with us tonight?
So I know you said, what's the one thing that everybody can do, but I want to retract my question. I think having a mindset of a wealth builder, right? That requires you to think differently than the average person that's out here, because your average person is okay with going to work and coming home and drinking a 6-pack of beer, and that is okay. That is no shade. But if you want something different from your life, you got to think different, and then you have to do certain things differently. You might have to read differently. You got to hang around with different people. But at the end of the day, you got to say, you know what? The responsibility is up to me. It's on me. I can't depend on anybody else. It's on me. I have to go seek. I have to go find. I can't just be lackadaisical about getting what I need for myself and my family. I got to go out and do it.
That's awesome. What you reading right now before we go?
I'm rereading. Well, let me see, because I don't read anymore. I'm trying to get back to it. I'm going to show you one book that I'm starting to read, but I've been reading this book here. Ashada.
Okay.
But I'm also reading it, so I want to pull it up because I listen to a lot of books.
Okay.
I listen to a lot of books. Audible is like my best friend. And by the way, Audible is not paying us, so no commercials for them. Let's see. Let me pull it up real quick, and you'll get a kick out of this. I'm reading We Should All Be Millionaires by Rachel Rodgers.
Okay.
I find it really interesting. It's a book, and it's written for women. However, when you look at women, the plight of women and the plight of quote unquote Black folks is very, very similar. We don't have the same biology, but we got a lot of the same plight. So I think it's so good. I think it's good right now. What are you reading, Jeff?
I'm reading right now. The men in my group at church, we're going through the Samson syndrome and what every man can learn from the baddest man in the Bible. The Samson syndrome.
Bad
Yes, that's
as good or bad as
baddest man
bad?
in the Bible. Samson. Samson was powerful man in the Bible.
Yes, he was. Yes, he was. He had a
So we
lot of
reading it with the syndrome. I'm just starting to get the book to read it to kind of find like all the magic in the book, so I can report on you a little bit later. But I'm surprised you ain't mentioned this book right here.
I'm sorry. I'm sorry.
I'm surprised
I'm sorry.
you didn't mention the basic no BS guide to building indestructible wealth by your boy
That's
Jeff
right.
Moore.
Jeff the Ball Builder.
That's right,
Absolutely.
and everybody that
Drop the ball on that. That's how you know this is real. This is real, right? It's not propped up.
okay didn't. So I wanted to write a money guide. This book was like written for. I wrote this book for me and the stuff that I wished I would have learned or wished I would have knew when the 2008 crash happened. So that was the motivation behind this book.
So what's the one?
You went out on me. What you say?
What's the one thing you wish you would have known?
Have a money system. Give my money some directions when I made it, like what to do with my money as it came in.
Because we know money without a plan will wind up in the hands of somebody else and make them richer. That is
Word
a fact.
up.
That is a fact.
And that was one of the biggest things that I was like, wow. And it's funny, like, because we never get this education on this money game, like, what should we be doing with our money, and just by being in the financial services industry for the past 29 years, I'm learning that there's so much profit in the confusion. Like, they want you dumb and they want you guessing with your money because that's where they make all the profit. And it's like, man, if you could get people to like really to follow a system, a plain money system, it would help to avoid a lot of the noise. It would help people to avoid a lot of the scams. A lot of people always losing a lot of money trying to get rich quick. It helps to alleviate a whole lot of different things, and unfortunately, I had to learn the hard way because I didn't have a money system. So it's my gift, like, to make sure, and it's my passion to make sure that people don't have to learn the hard way like I had to learn, and that's why the money system and having a money system and having a tax plan and making sure that your living will and your power of attorney is in place, and making sure that you have a strategy, not just a strategy for making money babies, but also a strategy for paying taxes. So these are some of the things and some of the structures and some of the things that I wish was in place, like, back where, when there was so much financial turbulence all around the place. And a lot of people lost a lot of money and a lot of people lost a lot of time. So that's kind of the lessons that, I put in the book on what to do so you can avoid a lot of that.
I like that. I like that. I like that.
So that's where we are. Any last words? I mean, let people know where they can find you again. Let people know that you are going to be on the stage this Saturday at the Basic Financial Education Boot Camp. When you understand what's going on, you know what to do. Kamari is going to be there to help you to understand some of the stuff that's going on with this taxes and kind of take some of the complexity out of it and make sure that you have a system for doing your taxes, that you can avoid all of the noise and not get caught up into all of the negativity and the feelings and emotions of when April comes and you have to do your taxes. So make sure you come. You have an opportunity to meet him, shake his hand, shake hands with a legend. Philly legend, 30 years in the game, tax strategist, tax professional, come and say hello to my man and bless him and get this financial information he's going to talk about. You want to share a little bit about what you're going to talk about on Saturday?
No, we're going to talk about why rich people love the IRS. That's what we're going to talk about on Saturday.
Why rich people love I cannot wait. Woo, I cannot wait. You better get your ticket. And we got a special incentive going on until midnight tonight where you can go to basicwealthtour.com, use code HNY, Happy New Year 2026, and you can get your ticket at a special discount that you can come and be with us. We're going to be at Maggiano's in Cherry Hill on Saturday from 10 to 4. We're going to feed you. We have 4 dynamic guest speakers that's going to come and bless you with information to change your money situation. And we're going to give you a 90-day wealth plan to kick off 2026. So if you miss it, you're going to miss a lot. And come meet Mr. Ellis and, come find out how you can have him be your tax professional, because everybody's looking for a good tax professional and he is a good one. And we want him to be able to help you kind of navigate this tax road so you can financially win. Any other words you would like to say before we jet out of here?
No, just thank you, Jeff. Thank you for dragging me out of my cubby hole and dragging me over to Cherry Hill. I love Maggiano, so we'll have a good time. We'll have a good time.
That's right. We're going to make sure the world get to experience your genius, because you've been hiding that genius for too long. It's time for you to put it out in the street so people can get some of that financial genius.
All righty now.
Have a great day, guys, and we will see you on Saturday.
Thanks again.